Gold is moving up in the face of a strong dollar. So when the dollar turns, if the dollar turns, then gold could move just dramatically higher in terms of US prices. I don't know. I wouldn't be surprised at all to see, we might get some backwards and forwards at the 3,000 level. We often do. But the way gold is moving right now, I think we could easily just break right through it. And remember, if most of your buyers are non-US people, right, they're looking at gold priced in Australian dollars or Chinese yuan or Japanese yen. They're looking at gold in their own currency terms. And so 3,000 is not a magic number for them. So I wouldn't be at all surprised to see 3,500 to 4,000, that kind of range, within the next 12 months.
In a comprehensive analysis of the gold market, renowned global investment expert AdrianDay offers insights into the complex dynamics driving precious metal prices. Many gold buyers operate outside the United States, pricing the metal in currencies such as the Australian dollar, Chinese yuan, and Japanese yen. This global perspective suggests that while the $3,000 mark may captivate U.S. investors, it holds less significance for international buyers. The market has recently witnessed interesting movements, with gold prices trimming their early advances on Friday to settle around the $2,860 region per troy ounce following the release of the January U.S. labor market report. Despite these short-term fluctuations, analysts maintain an optimistic outlook, projecting gold to surpass $2,900 in the first quarter of 2025, potentially reaching or exceeding $3,000 later in the year. Day anticipates even more dramatic gains, suggesting prices could reach between $3,500 and $4,000 in the next 12 months. What makes the current gold rally particularly noteworthy is its resilience in the face of a strong U.S. dollar. Day points out that this unusual pattern suggests the potential for significant upside if the dollar weakens, especially in U.S. dollar terms. Long-term forecasts support this bullish outlook, predicting gold prices to reach $3,500 by 2026 and surpass $4,000 by 2027. The market's recent behavior reflects these complex dynamics, with gold experiencing an intraday decline that ended a 5-day winning streak to its all-time high. This correction was primarily driven by the U.S. dollar's modest rebound from a 1-week low and improved risk sentiment, leading to profit-taking by bullish traders in what appeared to be slightly overbought market conditions. Before we get started, please remember to subscribe to our channel and hit the bell icon to stay updated. This will ensure you'll always be informed about our latest content and insights.
I think we all know that the main driver of gold for the last 2 years has been central banks in an effort to diversify away from, dollars in their reserves in the face of dollar weaponization. So we all know that's been the driver. And of course, the central banks that have been buying gold, and as you mentioned, last year was another record high. December was very, very strong. So it seems to be accelerating, there's no pause. People were thinking there'd be a pause. But that has nothing to do with the strength of the dollar or the strength of the U.S. economy or whether interest rates are positive or negative on a real basis in the U.S. Or the jobs market or anything else. It has nothing to do with what's happening in the U.S. The sort of traditional drivers of gold, if you like, the macroeconomic drivers of gold, is not what's been driving gold this time. And it's not just central banks, of course. Beginning of last year, we saw a big spike in Chinese consumer buying of gold in the face of a declining economy or fears of a declining economy in China, yuan depreciation, and of course concerns about the fragility of the banking system. So Chinese consumers moved into gold. But again, that has nothing to do with what I call the traditional macroeconomic drivers of gold. Gold has been remarkably resilient. We did see that bit of a decline when it looked like, when Trump was elected, President Trump was elected. It started, at the end of October, right before the election. So we saw a little bit of a decline. I honestly thought it was going to be a bit of a longer and deeper decline. But to me, it just shows that there is an awful lot of pent-up demand among central banks. I mentioned the Chinese, and also, of course, very wealthy individuals and families in the Middle East and in Asia in particular, but also in Europe, have been buying gold as protection against, let's say, the fragility of the financial system. With record debt everywhere you look, both at the government level and in many countries at the household level, the debt levels among governments are frankly unsustainable. And so I think people are buying gold as a protection against that. You alluded to it at the beginning, and I think, we'll get to it, I'm sure. But the one source of demand that isn't there right now is what I'll call ordinary retail investing in North America. That's just not in the market right now. You had you had US people move gold from holdings in London via Switzerland, because bars have to be refined to move to the US. You have people moving gold to the US ahead of tariffs, because, of course, if tariffs were imposed on Europe and the UK, even 10%, nobody's going to want to buy gold or import their gold when it's 10%. So people were moving ahead of that. But you know what happens with arbitrages? Normally, they work themselves out. As more and more people take advantage of that arbitrage. And just as we saw this move from London to the US during COVID, when people were afraid they simply wouldn't be able to ship gold. Now it's for other reasons, but they wouldn't be able. That unwound once the COVID panic was over. And I think this is going to unwind at some point once the tariff panic, if you like, is over.
In a revealing analysis of the gold mining sector, investment expert AdrianDay spotlights a significant market disconnect. While gold prices soar to unprecedented levels, recently exceeding $2,840, Day observes that market attention has been misplaced on cost inflation rather than the sector's expanding profit margins. The economics are compelling. Mining companies are experiencing widening profit margins as gold prices rise faster than operational costs. This creates a powerful leverage effect where each ounce of gold produced generates increasingly higher profits. The phenomenon has contributed to gold miners becoming top-performing asset classes in 2024 and early 2025. Day argues that this situation presents a unique investment opportunity. While analysts and executives focus on cost pressures, they overlook the fundamental improvement in mining economics. The sector's strength is particularly noteworthy as it persists even without some of 2024's supporting factors, bolstered by additional catalysts, including trade tensions and potential Federal Reserve policy shifts. For investors, this disconnect between market perception and operational reality could represent an attractive entry point into gold mining stocks. As mining companies continue to benefit from high gold prices while maintaining relatively stable costs, their improving profitability metrics suggest the potential for significant stock price appreciation. Let's get back to the interview.
Well, what we're not seeing, we're not seeing the move of generalist investors into gold into gold equities, because the macroeconomic environment has not, until very recently, has not seemed conducive to gold investments. When the broad stock market is continuing to move up, albeit with very bad breaths, but the S&P is continuing to move up. The economy is continuing to do well. The dollar is still reasonably strong, and inflation is down, is low, and apparently under control. I don't think it is, but apparently under control. In that kind of environment, people aren't looking at gold investments, and that makes perfectly logical sense. But I think we're going to see, one by one, we're going to see those supports fall away, if you like. The U.S. stock market is already sort of, let's say, turning over. I won't say turning. I won't say that it's going to have a crash anytime soon. But you look at the erstwhile leaders, look at Apple and Microsoft and NVIDIA. We've seen big declines in those stocks in the last few weeks. And the S&P is let's say the S&P is no longer the one-way bullet train that we thought it was. You look at inflation, you now look at the last 5 months, whether it's CPI or whether it's PCE or PCE core, or whatever you want to look at. The last 5 months, the trend is definitely moving back upwards. So at the minimum, we can say inflation is stubborn and a long way above this arbitrary, artificial 2% target that the Fed has. So one by one, these things are going to fall away. And I think people, and the last sort of hurdle, if you like, or the last thing to fall will probably be the dollar. But as these things fall away, people will start to look more at gold, and they'll start to look at gold stocks. And one thing to remember, we mentioned that gold's at record highs, and we mentioned that the gold stocks are undervalued or haven't had the leverage that they normally have. But let's not forget, not only is gold price at record highs, but the margins of the gold miners are actually expanding. the gold price is moving up over the last 12 months far faster, far more rapidly than the costs of mining. And yet every mining executive you talk to, every mining analyst you talk to, on every quarterly conference call for the last 12 months that I attended of dozens of companies, everyone's asking about costs and inflation and everything else. Why doesn't someone just stand up and say the gold price is moving up faster than our costs are moving up? And so the margins are expanding. This is in my view, this is a fantastic opportunity for the gold stocks. Everybody thinks of gold as an inflation hedge. If you asked 100 people in the street, 99 would say gold's an inflation hedge. And that's because of recency bias. In the 1970s, gold was an inflation hedge. But throughout history, gold has acted better in deflations and in inflations, but gold is really a hedge against monetary chaos. And that can be inflation, or it can be deflation, or it can be recession. And in a recession, of course, people go to gold, and the statistics show this up. I don't have them off the top of my head, but in the last, 9 recessions since the 1960s, gold has gone up in about 7 out of 9. So gold has a very good track record of going up during recessions. And the reason gold goes up in recessions is because in a recession, you start to look ahead and say that the central banks are going to have to cut interest rates and ease monetary policy. And that's positive for gold. It's not the recession itself is good for gold. It's the response to a recession is good for gold. So I think we're definitely heading towards a stagflationary environment, in my view, and that will be positive for gold.
Gold remains strong in the current market, reaching new record highs amid economic uncertainty and geopolitical risks. Its resilience as a haven and the expanding profit margins in mining suggest gold's continued appeal as both a defensive asset and a profitable investment. What are your thoughts on gold's future? Let us know in the comments and see you in the following video. If you found this video helpful, don't forget to like, share, and subscribe for more insights. Hit the bell icon to stay updated with our latest content. Thanks for watching.